A major financial institution has collapsed, and silver markets are responding with a price surge that mainstream financial coverage has largely ignored or downplayed. This is not coincidence, nor is it speculative frenzy. The movement represents a market signal that sophisticated investors recognize as a warning about deeper systemic fragility. While official statements emphasize deposit insurance protection and contained risk, the precious metals market tells a different story, one that business owners and entrepreneurs must understand before the crisis accelerates beyond the point where protective action remains feasible. The institution in question failed due to a combination of interest rate risk, deposit flight, and asset liability mismatch that has become endemic across the regional banking sector. The bank held a substantial portfolio of long-term bonds and commercial real estate loans acquired when interest rates stood near zero. As the Federal Reserve raised rates aggressively to combat inflation, the market value of those assets declined sharply while depositors demanded higher yields or moved funds to money market accounts and treasury bills. The institution faced a classic bank run, not from panicked retail customers forming physical lines, but from sophisticated corporate depositors moving millions electronically within minutes. Once deposit outflows accelerated, the bank discovered that selling assets to meet redemptions would crystallize losses that exceeded capital reserves. Regulatory authorities seized the institution before markets opened, announcing a resolution plan that protected depositors but wiped out equity holders and left bondholders facing significant haircuts. This failure follows an established pattern visible since March 2023, when Silicon Valley Bank, Signature Bank, and First Republic collapsed within weeks. The underlying mechanics remain identical. Banks borrowed short-term through deposits and lent long-term through mortgages and bonds, assuming interest rates would remain perpetually suppressed. When that assumption proved false, the banking model broke. What distinguishes the current failure is its timing, occurring after regulators claim to have addressed systemic vulnerabilities through enhanced supervision and liquidity requirements. The speed of collapse mirrors previous episodes, transitioning from apparent stability to receivership within 72 hours once deposit flight reached critical velocity. The Federal Reserve activated emergency lending facilities within hours, signaling awareness that contagion risk extends beyond the single institution. Silver responded to the failure announcement with an immediate price spike exceeding 8% intraday, significantly outpacing gold's more modest 3% gain. Trading volume in silver futures surged to levels not seen since the March 2023 banking crisis, with over 200 million ounces changing hands in paper markets. More significantly, physical silver premiums expanded dramatically as retail demand overwhelmed dealer inventories. Silver Eagles commanded premiums of 5.7 over spot price, while delivery delays extended from days to weeks. The divergence between paper price and physical availability indicates that the futures market, where most price discovery occurs, substantially undervalues the metal relative to actual supply-demand fundamentals. This pattern has characterized every banking crisis since 2008. Paper markets initially suppress prices through leveraged selling, while physical markets experience shortages that eventually force paper prices higher. Historical comparison provides essential context. During the 2008 financial crisis, silver initially declined from $20 to $9 as leveraged positions liquidated, then surged to $49 by 2011 as the full scope of monetary debasement became apparent. Following the 1987 stock market crash, silver rallied 40% within 6 months as confidence in financial system stability eroded. The 1970s stagflation era saw silver rise from $1.50 to $50 as banking crises and currency debasement undermined faith in paper assets. The current spike, while modest in absolute terms, represents the initial recognition phase, the moment when a subset of market participants acknowledges that official reassurances no longer align with observable reality. What the official narrative systematically omits deserves careful examination. Regulatory agencies emphasize that deposit insurance protects account holders up to $250,000, implying that the system remains sound. This ignores that most business operating accounts and treasury management balances far exceed insured limits, leaving corporate depositors exposed to losses or lengthy recovery processes. The Federal Deposit Insurance Corporation's fund contains approximately $125 billion to protect over $10 trillion in insured deposits, a ratio of 1.25% that becomes meaningless during widespread failures. Government statements focus on the individual institution as mismanagement, while avoiding discussion of how many other banks face identical vulnerabilities. Media coverage follows predictable patterns, describing the failure as an isolated incident involving unique circumstances, rather than a symptom of systemic fragility. Financial networks interview analysts who emphasize that the system is much stronger than 2008, and that regulators have the tools to contain any spillover. These assessments ignore that total bank unrealized losses on securities holdings exceed $500 billion, that commercial real estate distress is accelerating, and that the Federal Reserve's emergency lending facilities show sustained usage levels indicating chronic stress rather than temporary dislocation. The absence of silver market coverage in mainstream financial media reflects institutional bias. Acknowledging precious metals as crisis indicators undermines confidence in paper currency and financial intermediaries. The gap between central bank actions and public statements reveals the true assessment of system stability. While officials project confidence, central banks globally continue purchasing gold at record rates. The People's Bank of China, Reserve Bank of India, Central Bank of Turkey, and numerous emerging market central banks have accelerated accumulation, signaling that monetary authorities recognize currency and banking system vulnerabilities, even as they publicly maintain stability narratives. Poland's central bank increased gold reserves by 130 tons in 2023, while Singapore's monetary authority refuses to disclose full reserve compositions, suggesting precious metals holdings exceed publicly reported figures. These actions by the ultimate insiders, entities with access to complete information about financial system health, provide more reliable guidance than official press releases designed to maintain confidence. Silver's price spike following this bank failure represents the market's assessment of systemic risk exceeding official acknowledgement. For business owners and entrepreneurs, the signal is clear. The banking system's fragility has reached levels where individual institution failures can occur with minimal warning, and precious metals markets recognize this reality faster than equity or bond markets. The question is not whether to take the warning seriously, but whether to act before the next phase of the crisis eliminates the opportunity for protective positioning. The failed institution did not collapse due to unique mismanagement or exceptional risk-taking. It failed because it operated within a banking system built on structural contradictions that have intensified since the 2008 financial crisis and reached critical instability following the pandemic monetary response. Understanding why silver responds so dramatically to bank failures requires examining the systemic context that makes these failures inevitable rather than anomalous, and recognizing that the current episode represents an early stage of a broader unraveling that cannot be contained through regulatory intervention or emergency lending. Regional and community banks across the United States hold approximately $1.7 trillion in unrealized losses on securities portfolios as of the most recent Federal Reserve data. These losses remain unrealized only because accounting rules allow banks to classify bonds as held to maturity rather than marking them to market value. The fiction works until depositors withdraw funds, forcing asset sales that crystallize losses and consume capital. As interest rates rose from near zero to over 5%, the value of long-term bonds purchased during the ultra-low rate era declined by 20 to 40%. A bank that appeared well capitalized with an 8% capital ratio discovers that marking its bond portfolio to market eliminates that capital entirely. Hundreds of institutions face this reality, creating a system where apparent solvency depends on depositor passivity, a fragile foundation during periods of declining confidence. Commercial real estate exposure compounds banking sector vulnerability in ways that receive insufficient attention. Office buildings have lost 30-50% of their value in major metropolitan areas as remote work permanently reduces demand. Retail properties face persistent pressure from e-commerce competition. The approximately $1.5 trillion in commercial real estate loans requiring refinancing between 2024 and 2027 will roll over at interest rates double or triple the original terms. Many properties cannot generate sufficient income to service debt at current valuations and rates, forcing defaults that erode bank capital. Regional banks hold over 70% of all commercial real estate loans, concentrating the risk in institutions with less capital cushion than money center banks. Each default requires loan loss reserves that reduce the capital available to absorb securities losses or fund new lending. The Federal Reserve's emergency lending facilities, established during the March 2023 banking crisis, continue showing sustained usage that indicates chronic stress rather than temporary liquidity needs. The Bank Term Funding Program allows banks to borrow against bond holdings at par value rather than market value, effectively providing loans against securities worth 20-30% less than the advance amount. Outstanding borrowing through this facility has remained elevated for over 18 months, demonstrating that a significant number of institutions cannot fund operations through normal deposit growth or interbank lending. This represents stealth bailout infrastructure, preventing immediate failures while doing nothing to address the underlying insolvency that makes the borrowing necessary. Deposit Insurance Fund adequacy presents perhaps the most consequential vulnerability that regulators consistently misrepresent. The FDIC's Deposit Insurance Fund contains $125 billion, or an amount established as adequate when the insured deposit base was significantly smaller and when regulators believed simultaneous failures of multiple institutions remained unlikely. The fund represents approximately 1.25% of insured deposits, meaning that failures affecting more than 1.25% of the banking system exhaust available resources. During the 2008 crisis, the FDIC borrowed $100 billion from the Treasury and imposed special assessments on surviving banks to replenish the fund. The current structure provides no additional backstop beyond Treasury borrowing authority, meaning that widespread failures would require either taxpayer bailouts or depositor losses exceeding insured limits. The interconnections between institutions create contagion pathways that make isolated failures impossible once confidence erodes. Banks lend to each other through the federal funds market and hold deposits at other institutions as correspondent banking relationships. When one institution fails, counterparties reassess exposure to similar institutions and withdraw funding preemptively. The interbank market, which relies on trust and perceived credit quality, freezes rapidly once doubt emerges about any significant participant's stability. This dynamic transformed Lehman Brothers' failure in 2008 from a single firm bankruptcy into a global credit freeze within days. The system has grown more interconnected since 2008, not less, despite regulatory efforts to reduce systemic risk. Derivatives exposure adds exponential leverage to underlying banking system stress. Interest rate swaps, credit default swaps, and foreign exchange contracts create obligations that must be settled even as the institutions holding them face capital impairment. The Bank for International Settlements reports over $600 trillion in notional derivatives outstanding. While net exposure is substantially lower due to offsetting positions, the complexity and interconnection mean that a major institution's failure triggers margin calls and collateral demands throughout the system. These cascade effects explain why authorities intervene immediately to prevent large institution failures, not from concern about depositor protection, but from awareness that derivatives unwinding could overwhelm clearing systems and settlement infrastructure. Silver's dramatic response to banking failures reflects its unique position as the most accessible monetary alternative to a failing paper currency system. Gold moves during banking crises, but its high price per ounce limits accessibility for average investors and small businesses. Silver provides the same non-counterparty risk characteristics at a price point that allows broader participation. When banks fail, sophisticated market participants immediately recognize that currency held as deposits represents claims on an insolvent system. The rush to convert paper claims into physical assets with no counterparty risk drives precious metals, demand that overwhelms available supply. Silver's smaller market size relative to gold means that equivalent dollar flows generate larger percentage price movements, explaining why silver typically moves 3 or 5 times as dramatically as gold during banking crises. The reflexive dynamic between bank failures and precious metals prices creates a feedback loop that authorities cannot control through intervention. As silver prices spike, the visible market signal of systemic distress spreads to broader audiences, accelerating deposit withdrawals from vulnerable institutions. This forces more asset sales, crystallizing more losses, requiring more emergency lending, and validating the initial concerns that drove precious metals buying. Central banks can provide unlimited liquidity through lending facilities, but they cannot restore confidence once depositors and institutional counterparties conclude that the system's stability depends on continuous central bank support. That recognition represents the terminal phase of fiat currency regimes, the point where the distinction between liquidity and solvency collapses, and market participants seek exit regardless of official reassurances. The current bank failure and silver spike must be understood within this systemic context. The failed institution was not an outlier, but rather the most visible manifestation of vulnerabilities affecting hundreds of similar institutions. The silver market's response was not speculative excess, but rather informed recognition that banking system fragility has reached levels where containment becomes increasingly difficult. For business owners and entrepreneurs, the analytical task is straightforward. Assess whether the systemic vulnerabilities outlined here have been addressed or merely deferred through emergency interventions that expand central bank balance sheets and compound long-term instability. The answer determines whether the current silver spike represents a temporary dislocation or the beginning of a sustained repricing that reflects currency and banking system failure becoming undeniable rather than theoretical. Silver's function as a monetary crisis barometer extends across millennia, yet its specific characteristics make it particularly sensitive to modern banking system stress. Unlike gold, which central banks hold as reserves and which maintains steady institutional demand, silver occupies a unique position between monetary asset and industrial commodity. This dual nature, combined with market structure vulnerabilities and supply constraints, creates conditions where banking failures translate almost immediately into price spikes that precede broader recognition of systemic instability. Understanding these mechanisms explains why silver moved 8% on bank failure news while equity markets remained relatively stable, and why this divergence represents valuable advance warning for those positioned to interpret it correctly. Throughout monetary history, silver has functioned as the common person's monetary insurance, the accessible store of value when gold's price exceeds practical reach. During the Roman Empire's currency debasement, citizens hoarded silver denarii as bronze coins lost purchasing power. Weimar Germany's hyperinflation saw ordinary Germans converting paper marks into any available silver as Reichsmarks approached worthlessness. The Hunt brothers' silver accumulation in the late 1970s, while ending in spectacular failure, occurred against a backdrop of dollar devaluation and banking system stress that drove broader demand. The 2008 financial crisis produced an initial silver sell-off as leverage positions liquidated, followed by a 450% gain from 2008 lows to 2011 highs as quantitative easing and bank bailouts validated concerns about currency stability. The pattern repeats because the underlying dynamics remain constant. When faith in paper currency and banking system stability erodes, those seeking to preserve wealth gravitate toward tangible assets with no counterparty risk. The mechanism through which banking failures translate to precious metals demand operates through multiple channels simultaneously. Corporate treasury managers holding deposits exceeding FDIC insurance limits immediately reassess counterparty risk when peer institutions fail. A manufacturing company with $50 million in operating deposits spread across 3 banks recognizes that 49.25 million remains uninsured and vulnerable to loss or lengthy recovery periods if those institutions fail. Converting a portion of liquid reserves into physical precious metals eliminates counterparty risk entirely while maintaining value that can be liquidated when needed. High net worth individuals follow similar logic, recognizing that bank deposits represent unsecured loans to potentially insolvent institutions rather than safe storage. Institutional investors who manage risk systematically increase precious metals allocations when banking system stress indicators rise. Hedge funds, family offices, and sovereign wealth funds monitor the same metrics that indicate systemic fragility: unrealized losses, deposit flight, emergency lending facility usage, and commercial real estate distress. When these indicators reach concerning levels and manifest in actual failures, allocation models trigger increased commodity exposure as a portfolio hedge. Unlike retail investors who may react emotionally, institutional flows represent calculated risk management that persists until the underlying stress resolves, a resolution that requires either economic recession that forces interest rates lower, inflation that erodes the real value of bank assets and liabilities, or explicit government recapitalization of the banking system through taxpayer funds. Physical silver supply constraints amplify price movements in ways that gold markets do not experience to the same degree. Annual silver mine production totals approximately 830 million ounces, with another 180 million ounces from recycling. Against this supply, industrial demand consumes roughly 550 million ounces. Investment demand varies between 150 to 300 million ounces, depending on market conditions, and jewelry and silverware account for another 200 million ounces. The market operates with minimal surplus under normal conditions, meaning that investment demand increases of even 50 million ounces, representing less than 1.5 billion at current prices, can generate significant price pressure. During banking crises, investment demand can surge by 100 to 200 million ounces as both retail and institutional buyers seek monetary insurance, creating physical shortages that force premiums higher and eventually pull paper prices upward. The paper-silver market structure introduces additional volatility that turns banking system stress into explosive price movements. The COMEX silver futures market trades volumes exceeding 150 million ounces daily, while registered silver available for delivery totals approximately 40 million ounces, a ratio of nearly 4.1 between daily volume and available inventory. This leverage means that if even 5% of contract holders demand physical delivery rather than cash settlement, available supply becomes insufficient. Banks and bullion dealers who sell paper silver through unallocated accounts or ETFs maintain fractional reserves against their obligations, assuming that redemption requests will remain manageable. During banking crises, this assumption fails as redemption requests surge, forcing these institutions to source physical metal that trades at significant premiums to the paper price they sold. Institutional versus retail buying patterns during bank failures show distinct characteristics that create sustained price pressure. Retail investors typically buy smaller quantities through dealers, accepting current premiums and delivery delays. This demand manifests quickly, but can pause if prices rise sharply. Institutional buyers source larger quantities through wholesale channels and forward contracts, locking in supply at negotiated premiums. Once institutional buying begins, it continues until allocations reach target levels regardless of short-term price movements, creating a floor under markets that prevents corrections. The current bank failure triggered both retail and institutional responses. Retail buying evident in dealer inventory depletion and premium expansion, institutional buying visible in futures market positioning and wholesale transaction volumes. Geographic analysis reveals that physical silver buying during banking stress concentrates in regions with direct exposure to financial instability. Following the March 2023 U.S. banking failures, American dealers experienced unprecedented demand while European and Asian demand remained elevated but less extreme. The current failure produced similar patterns, with North American premiums expanding more aggressively than international markets. However, as banking stress spreads or as international awareness of U.S. banking fragility increases, geographic buying patterns broaden. Chinese and Indian buyers, who traditionally focus on gold, increasingly view silver as accessible monetary insurance during periods when gold reaches record highs in local currency terms. The reflexive relationship between silver price movements and banking system confidence creates a feedback loop that authorities cannot control through traditional policy tools. As silver spikes in response to bank failures, the visible market signal of distress spreads through financial media and social platforms, reaching audiences who may not follow banking sector news closely. This awareness drives additional deposit withdrawals from vulnerable institutions as both businesses and individuals reassess counterparty risk. The accelerated deposit flight forces more banks toward failure thresholds, validating the concerns that drove initial precious metals buying. Each iteration of the loop increases the portion of market participants who recognize systemic fragility, expanding the base of potential precious metals buyers and reducing the effectiveness of official reassurances. Central bank attempts to suppress precious metals prices during banking crises through futures market intervention face limitations that have become increasingly apparent. Sales of paper gold and silver through futures markets can temporarily cap prices, but physical demand continues regardless of paper price. The divergence between paper and physical markets eventually forces paper prices higher, as arbitrageurs recognize the unsustainability of futures prices below replacement cost. More fundamentally, market participants increasingly understand that central bank price suppression efforts during crises validate rather than refute concerns about systemic stability. If the system were truly sound, authorities would have no reason to manipulate precious metals prices. For business owners and entrepreneurs, silver's function as early warning system provides advanced notice of banking system stress before it reaches crisis proportions that force reactive decisions under duress. The current 8% spike following a single bank failure represents the preliminary signal. The market's assessment that systemic fragility has reached levels where additional failures should be expected rather than surprised by. The strategic question is whether to treat this signal as noise to be ignored or as actionable intelligence requiring immediate positioning adjustments. The historical record suggests that those who act on early warnings preserve capital, while those who wait for crisis confirmation discover that protective assets have become expensive or unavailable precisely when they are most needed. The conjunction of a major bank failure and silver's pronounced price spike creates a decision point for business owners and entrepreneurs. The choice is not between action and inaction, but between proactive positioning during a period when protective measures remain available at reasonable cost versus reactive scrambling during acute crisis, when options narrow dramatically and prices for safety assets surge beyond practical reach. This analysis provides a framework for strategic response based on the systemic vulnerabilities outlined in the historical progression of banking crises, from isolated failures to contagion to systemic disruption. Business banking. Relationship diversification represents the most immediate operational imperative. Companies maintaining all deposits and credit facilities with a single institution face concentration risk that became acutely visible during the March 2023 failures when businesses lost access to operating accounts overnight. Best practice requires maintaining relationships with at least 3 institutions across different size categories: a major money center bank, a large regional bank, and a community bank or credit union. This structure ensures that a single institution's failure does not paralyze operations while providing geographic and regulatory diversity. Treasury management accounts should be distributed to keep balances at each institution below FDIC insurance limits where feasible, recognizing that many businesses cannot fully insure operating capital but can limit uninsured exposure. Credit facility establishment before crisis accelerates, provides access to liquidity when credit markets tighten. Banks extend credit readily during stable periods and restrict availability immediately when systemic stress emerges. Businesses that wait until they need financing discover that underwriting standards have tightened and that institutions prioritize preserving capital over new commitments. Establishing revolving credit lines now, even at the cost of unused commitment fees, creates optionality that becomes invaluable during credit contractions. The cost of maintaining unused credit represents insurance against scenarios where external financing becomes prohibitively expensive or entirely unavailable. The case for immediate precious metals allocation rests on the asymmetry between the cost of protection and the cost of unpreparedness. Physical silver currently trades near historical lows relative to the monetary base, below inflation-adjusted 1980 highs, and at gold-to-silver ratios suggesting significant undervaluation. A business or individual allocating 10 to 20% of liquid reserves to physical precious metals pays current market prices plus modest premiums. If banking system stability deteriorates further, that allocation preserves purchasing power and provides liquidity when paper assets face impairment or restricted access. If the system somehow stabilizes without crisis, the downside remains limited to opportunity cost and storage expenses. The asymmetry strongly favors early positioning rather than waiting for crisis confirmation that arrives with $50 silver and unavailable physical inventory. Physical versus paper silver positioning requires understanding the fundamental distinction between ownership and exposure. Physical silver held in personal possession or allocated storage eliminates counterparty risk entirely. The owner holds metal that maintains value regardless of financial system dysfunction, bank failures, or brokerage insolvencies. Paper silver through ETFs, futures contracts, or unallocated accounts provides price exposure, but retains counterparty risk. The owner holds a claim against an institution that may be unable to deliver physical metal during crisis. The March 2020 precious metals market disruption demonstrated this distinction when ETF prices diverged from physical premiums by unprecedented margins, and futures contracts threatened delivery failures. For meaningful protection against banking system breakdown, physical ownership is non-negotiable. Operational continuity planning must address scenarios where payment systems experience disruption during banking failures or systemic stress. The assumption that electronic payments, payroll processing, and vendor transactions continue uninterrupted, regardless of banking sector. Instability represents dangerous complacency. The 2023 failures required emergency interventions to maintain payment system functionality, demonstrating that smooth operations depend on regulatory backstops that may not activate quickly enough during accelerated crises. Businesses should maintain relationships with multiple payment processors, establish backup payroll funding sources, and develop contingency plans for vendor payments if primary banking channels become temporarily inaccessible. Cash management strategies during banking instability require balancing operational needs against preservation concerns. Maintaining minimum necessary deposits at operating banks provides transaction capability while reducing exposure to institutional failure. Excess cash should be distributed across multiple institutions or converted to treasury bills held in direct custody rather than through bank brokerage accounts. Money market funds provide another alternative, though these vehicles faced stress during the 2008 crisis and required government backstops to prevent collapse. The fundamental principle holds across all cash management decisions. Institutions holding others' money face structural incentives to invest that money in ways that generate returns, necessarily accepting risk that can result in inability to return funds on demand. The progression from isolated bank failure to contagion to systemic crisis follows predictable patterns visible in every modern banking crisis. The initial failure produces official reassurances about containment and system strength. These statements initially stabilize markets and temporarily halt deposit flight. Within weeks or months, a second institution fails, invalidating containment narratives and accelerating deposit withdrawals from similar institutions. The crisis enters the contagion phase, where market participants conclude that official assessments were incorrect and that multiple institutions face similar vulnerabilities. The third phase, systemic crisis, emerges when contagion spreads beyond obvious peers to institutions previously considered safe, forcing comprehensive government intervention through unlimited guarantees, massive liquidity provision, or explicit nationalization. The current situation places the banking system in the early stages of this progression. The failure that triggered silver's spike represents the continuation of instability that began in March 2023, not an isolated event. Official statements emphasize strength and resilience, while emergency lending facilities show sustained usage that contradicts those assurances. The gap between narrative and observable reality indicates that authorities recognize system fragility, but must maintain confidence to prevent the self-fulfilling prophecy where acknowledgement of vulnerability triggers the very crisis they seek to avoid. For decision makers, the strategic insight is that official guidance provides unreliable signals during this phase. Actions speak more clearly than statements, and central banks' continued gold accumulation reveals their genuine assessment regardless of public commentary. Silver's spike represents a warning rather than the main event. The 8% single-day movement following bank failure news constitutes the market's preliminary assessment that systemic risk has increased materially. If the system stabilizes, through economic recession that lowers interest rates, through fiscal transfers that recapitalize banks, or through some combination of policy interventions that restore confidence, silver prices may moderate from current levels. However, the structural problems remain unsolved. Unpayable debt continues growing, unrealized losses persist on bank balance sheets, commercial real estate distress intensifies, and political willingness to impose fiscal discipline or accept economic pain remains absent. The more probable scenario involves continued instability, additional bank failures, and progressive loss of confidence that drives precious metals substantially higher from current entry points. The cost of waiting versus the cost of preparation defines the strategic choice facing business owners and entrepreneurs. Waiting preserves capital for current deployment in operating businesses or investment opportunities, avoiding the opportunity cost of idle precious metals holdings. This approach proves optimal if banking system stability somehow emerges despite structural evidence to the contrary. Preparing through diversified banking relationships, established credit facilities, and meaningful precious metals, allocation incurs immediate costs in the form of fees, premiums, and reduced deployment flexibility. This approach proves optimal if banking system stress continues progressing toward crisis as systemic indicators suggest. The asymmetry strongly favors preparation. The cost of premature positioning represents modest opportunity cost, while the cost of delayed positioning during acute crisis can mean business failure, capital impairment, or inability to access protective assets at any price. The silver spike following this bank failure provides clarity for those willing to interpret market signals rather than rely on official reassurances. The banking system's fragility has reached levels where individual institution failures occur with increasing frequency, where emergency lending facilities operate continuously rather than episodically, and where precious metals markets recognize systemic risk faster than equity or credit markets. The window for a strategic positioning remains open but narrows with each successive bank failure and each validation of systemic concerns. The choice between action and inaction will determine which businesses navigate the transition with capital preserved and operations intact, and which discover that the cost of unpreparedness far exceeds the cost of insurance purchased during the brief period when protection remained accessible. That period is now, and the decision cannot be deferred until crisis confirmation arrives, with options foreclosed and prices reflecting panic rather than prudent planning.